thank you for being here with me till the last minute, it seems. So I have a task, which is try not to follow the last line, which to defeat this concept that insurance is boring. So that was an interesting one, because I kind of agree up to a point, except that over these last few years is anything but boring, because it seems to be dealing with so many threats from anything. It looks like anything's been thrown at us and we need to figure it out. So what I'm going to do now is simply to present some topics which I think are of interest for us all, and particularly in the insurance industry. Not necessarily, this is not going to be, I warn you, focused on the Romanian insurance market. I'm just talking about very general things that should be more or less valid in anything we do anyway, regardless of the latitude or the longitude. And specifically, I'm going to talk about, well, it's what allows all of this to happen. At the end of the day, it's capital, capacity. So capacity in the market is determined, first of all, by the solvency, the strength of insurance companies, insurers that provide it. Then there is, of course, the side of the demand. And ultimately, reinsurance capacity is going to allow all this by allowing insurance companies to transfer risk. But then again, on the other side of the equation as well, down, 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 there is also all those works being made by agents. Particularly, that's a bit of an elusive market. We have a lot of numbers on reinsurance. We know exactly how it works, which are the major, we get statistics, we rank them ourselves as a rating agency as well, etc. And then there are all these underwriting agencies with delegated authorities, which write a lot of business, are a bit in the middle between being brokers and something else. I don't know how many they are. It's very difficult to measure, etc. For example, in Romania or in other markets in what is called East or Middle Europe. But I can tell you that, for example, in US, where we have a little bit more numbers, it is estimated that they represent about $60 billion and is growing. And it is also something like probably 10% of the non-life insurance market in UK, which is also remarkable. And we see signs that even in other markets, which are smaller, Italy, Spain, for example, etc., these people, these companies, sometimes of a small size, that write business in niche or in specialty lines on behalf of insurers and sometimes directly insurers, are becoming growing important. But I can define later on what a delegated authority is. We're saying really companies that don't retain the risk, but are given the authority to underwrite business on behalf of the insurer or insurer, sometimes go as far as to manage other parts of the process, such as claims. Now, coming back on, let's see if that works. How do I do with this? Okay. Oh, yeah. Okay, perfect. Thank you. So we're going to talk a little bit about what is that is driving results. We're getting some effect on results of insurance, and that is going to have a positive effect on pricing and terms. We have a market well capitalized, generally speaking, but is still subject to asset volatility. We'll come back to that. And by that, I mean that, especially in terms of the investment portfolio, and also there is a double effect. On one side, we have an effect on the P&L, and on the other side, directly on the balance sheet. And then we have outlooks, which we might say is stable at the moment, but is also showing some flux because it's a result of the volatility. Okay, this is the one I like because it shows a comparison between the return on equity and the cost of capital. Now, there is no attempt to introduce risk and adjusting here. We're just comparing straight lines. And you can see that for what is concerning the return on equity, the return of the level reached in the past in the last 2 years. And we have some interesting differences. Clearly, when we look at this, we might even have a philosophical question. Why exactly are we staying in a market, reinsurance, where sometimes the return on equity is actually below the cost of capital? It wouldn't make any sense, except that, thanks God, like in insurance and also in reinsurance, people take a long-term view. The bad spikes, by the way, if you look at the years in which we can see them, are also part specifically of crises we went through, such as COVID. At the moment, it's even more erratic. It could be due probably to effect like war, etc. So some of these might well last in 2024, but we'll have to see what happens in the contest. Now, in here, we are looking at, if I don't mistake, combined. Sorry, the right slide at all. Yeah, should be the one on combined ratio. So we can see that we are combined ratio above 100% all the way to 2020. So in that case, people could stay in business in reinsurance only because they've learned to live with an environment of low interest rates. Low interest rates, but sufficient to compensate for the high combined ratio with investment income. In the last 2 years, we can see a kind of return on profitability. 2019 was already heading to hard market, but then COVID came and it spoiled everything before even war came over. Okay, this should be slide 8. In the last 5 years, the average rate on return was something like gross 4.4%. And we need always to consider the COVID pandemic's effect lasting longer than the pandemics anyway. But we can factorize clearly the effect later on in terms of the inflationary pressure. Okay, here we have 2 considerations. The alternative capital, which would be the red part of the bar charts, seem to have reached its maximum level already by 2018. And not exactly so for the traditional capital or capacity, but eventually we are right there. So it seems like despite some reduction in the last year, we are more or less at the maximum we can ever think of. It's not going to be much bigger than that. It's going to be more or less at that level. It can go down a little bit due to some special effects, special pressure from the contest, geopolitical, etc. But we are more or less there. The other thing is not to be negative about this, because if you go all the way to the beginning of the graphic and you compare with nowadays, we can see that the overall sum of traditional capital and the very small alternative capital has increased by 60%. So it might not be that impressive on a yearly basis, but it's still a lot in absolute and percentage value. It's a lot of capital more, so we cannot really expect that much more to grow. Okay, because I know that we have a problem with time, I'm not going to go each and every one of these, but basically we're trying to analyze on one side the negative factor and on the other side the positive factor. So the factor that explains exactly why we expect the market to be stable, at the same time, if there are some factors that go contrarian, some counter tendency to this. And I would say the fact that there are so many natural catastrophes continues to keep interesting for cedants to seek for insurance capacity. For example, there is a high contest of uncertainty, geopolitical, inflation, rising interest rates, etc. The segment is still well capitalized, but interest rates hikes and volatile investment markets have materially reduced shareholders' equity on market value basis, etc. I think I will move to the next. Right. Okay. Here we try to begin to talk a little bit about 2 typical topics that were also mentioned, I think, in the keynote at the beginning. That is inflation and interest rates. In addition to the absolute levels reached, the pace of rate increases and inflation is particularly impressive. We have suddenly moved from a low interest rate environment, which had prevailed for years, to an environment in which we have levels rising sharply, with the central banks trying to contain that. So that ignites the kind of chain reaction between inflation rates and interest rates and vice versa, unfortunately, sometimes. Now, I don't have any more than anybody else or any other institution a crystal ball to say where exactly are going. Yes, we all notice that the pace of increase of the prices has kind of reduced, but we're still in inflationary terms. So the fact that we are even trying to measure the speed of inflation, derivative two in a way, it's a little bit strange. So it all depends. It could last. It's easy to say when we are in the business of prediction that tomorrow is going to be like today. We don't really know that. Sometimes it changes. That's what explains the entire dynamic. In the context of the insurance business model, rapid changes in rates can be an existential risk, unfortunately, at this point in time. In many ways, the model works best in a stable environment. That's how we work best as insurance. That's when we're boring. Boring has been very nice so far. So anything is predictable. The asset value we have, the liquidity, the time in which we need to get the reserve backs, the liquid to pay claims, etc. All that is a natural, positive environment for an insurance company, but it might not be exactly like that. Even though even in the past, long tail has always been particularly sensitive because of this, because the longer the time of the claim, then of course it gives you more time for changes. So the ideal situation would be short-term and boring, but it doesn't have to be like that, unfortunately, in this period. Changes in interest rates can lead to imbalance very quickly between assets and liabilities. And that's reflect also on liquidity, etc. We'll come back to that. But on the other side, the fact that we have a rise in interest rates creates opportunity on the side of life insurance, for example, because it was especially boring for policyholders to have the kind of very low return on policy. So in a way, that changes the game, and it might create opportunity for the companies that are able to jump to or to rise to the challenge. But definitely, if I wanted to conclude this, managing the transition from low interest rates environment is going to be the key, by all means. Okay, this is just, I don't really want to spend time on this, but it's just to focus visually. We've been really inflation by events. We always had natural disaster, but they seem to be the only event that was capable to influence reinsurance capacity and therefore down the chain, the capacity in the single market. And instead, if you look at the various events that I mentioned there is so much that has happened over the last few years that has created an environment in which sometimes we are dangerously aware of the fact that we don't know exactly what's going to happen tomorrow. But probably is not so much the question of digital technology or AI, but they are tools that should be considered by all means. It's the fact that it's not so much survival of the fittest, it's survival of the one who adapts best. Because there are so much that keeps changing and we don't know what's going to change in tomorrow. I remember a speech a couple of years ago, one of the people in the panel was talking about the fact that now we really need to be prepared for the next pandemics. And he was regretting not to have prepared before. But the point is, he was talking about pandemics because we were in the middle of COVID. So we were going to prepare for something we know. Nobody was prepared for the possibility of World War III, God forbid. And now we are thinking along those lines. So my point is, because there's going to be always something we don't know that's going to happen, then the best things to do is try to foster an organization also based on digital tools that allow those rapid changes. We cannot just keep having a strategy that can be reviewed only when the board meets, for example. That's not possible, I guess. But going on. Okay, just to make a little point about inflation, and then we'll come back to the interest rate. So at the onset during COVID-19 lockdown, there was a change of pace due to conflict. We assumed short-term at first, and now we assume to last into 2024. I have no idea, of course, if it's going to be true or not, and what's going to happen in 2025, where we're back to that. In terms of the insurance impact is obvious, the claims mostly. And on the other hand, I think they were talking about this before, the value proposition in terms of life product. I think this is going to be a real challenge because it's a bit like this. How exactly you're going to talk and communicate to your customers? Well, you could have a kind of aggressive stance. For example, tell them that the industry is very boring and they should buy new products. it might actually work. But I doubt that that system is going to work with all the policyholders on the life insurance side. Something else will have to be done, and which is really is, products need to be rethought in a way that still makes sense for who is offering them, but also for the people actually buying them. If there is no point in buying a life insurance or a capital insurance product because it offers no return and no saving and no nothing, I think that we're going to be stuck for a while with, of all the policyholders, the one that still don't find the time to cancel, but eventually they will exit that. And anybody else with something different could actually catch them. So the first sign of inflation appeared during the pandemic, at the end of the pandemic, and it was inflation that was fueled by disruption of supply chains. It was an inflation at the time that many saw as an inflation that was going to be measured and not going to last. And we saw that that's changed. The same kind of pattern happened at the very beginning with the Russian-Ukrainian conflict. We always wanted to send it away, but it lasted long. It's lasting longer than expected. What is exactly, from a rating agency point of view, the impact of insurer? There is an impact of unrealized capital gains with bonds. That's quite important because it doesn't matter where we are, which market, etc. It seems like for institutional, regulatory, and also normal industrial reasons, this industry tends to invest a lot its assets and everything in bonds. So in an inflationary environment, this is particularly bad because you are hit. It depends a lot how that is going to impact the rating, how much trust you have as an analyst in the capacity of insurers to wait till the natural expiry of the bond. Because if you think they have to sell in the middle, say, of its life, in a moment of high inflation, then they're going to have market value-based losses on the investment they did. If you think instead they're going to be able to wait, for example, long-term bonds, like 10-year bonds or 5-year bonds till the end, then you might avoid those losses and therefore avoiding an impact on the rating. Let me see if I think just want to jump to this. Lots of things are connected with this unpleasant effect on the assets and even liability side of the insurers. Instead of simply making diagnosis, one might expect perhaps a word of advice. So what exactly can be done about it? And this could be done also leveraging some of the things that were very interesting, actually, that we heard about, products and digital innovation. The only thing that you can do as an insurer is to adjust the prices. There's nothing else than that. At some point, it's a product you cannot have suddenly a high inflation environment of, say, 5 years, and to think you can go ahead like before, because at some level, somehow the capital is going to come. I don't think that's the way it's going at the insurance level. I don't think the way it can go. So it may be a truism, but the prices need to be, and it's a challenge, adjusted, which by that, I mean potential increases. The other way to do it. Obviously, something happens on the deductible automatically because of inflation, but you might have to adjust that too. If you want to keep the products interesting, and when I say interesting, I'm trying to say, if this inflation and this economic context continues, we'll have to accept the fact that we don't have in front of us the same middle class as before. People are going to have less money in the pockets. So how can certain type of products still be interesting for them? They need to be affordable. It sounds like another very boring word, but affordability is going to be the key. They need to be interested. They need to have a need, of course, to buy a certain product, but at the same time, it needs to be affordable. One way to work is on the price, of course. You may have to increase the price, but at the same time, you may have to reduce the deductible. Do something about it. Reconceive the product's life, for example, by which this can still be afforded by the policyholders you have in mind. Now let's go on the interest rates. Yes. I think I already mentioned before the unrealized losses, reducing the shareholders' funds. You have rising interest rates and higher spreads. They don't affect only the credibility of government. They affect also the balance sheet of companies. Bonds comprise bulk of portfolios. Higher default rates have not yet been observed, as a matter of fact, but Clearly, I think this is all for all the rating agencies, is something that we are monitoring because it's supposed to be an environment in which things happen that foster the type of possibility. In terms of insurer response, focus on, I would recommend, focus on diversification and resilience. Keep watching the credit risk. And probably a highlight, and we already seen that this is done actually, liquidity monitoring. In terms of rating consideration, it's very important for us to keep an economic but also an accounting view. They're two different things. It's important for us to evaluate the ability and intention to hold bonds and other financial instruments to maturity. I think I mentioned that before. There is the analysis of the potential liquidity requirements and the level of risk-adjusted capital, of course, and its capacity to absorb losses. So in terms of insurer response, on the investment side, we see that insurers facing a turbulent macroeconomic and geopolitical environment tend to focus on the diversification and resilience of their portfolio. They focus on credit risk management. Liquidity has been particularly a focus, and we're seeing companies increasing their monitoring analysis on the subject. Summarizing all this, and to close on bonds, if the company is willing and capable to hold bonds until the end, there may be a real question of how unrealized capital gains and losses should be considered in a risk-adjusted capitalization view of the company. In general, however, the ability of insurers to absorb more unrealized losses continues to be closely monitored. If rates continue to rise, we could well see the ability of insurers to manage these unrealized losses challenged. Another question is whether the increase in the spreads will not translate into an increase in defaults in the long run. I don't know how I'm doing with time. Okay, that was good to ask then. So I think we'll just say, I just want to say a few things about, I think I said before, I gave you some numbers even on delegated underwriting authority enterprises. So I don't want to repeat them at this point. Just one thing then. I would say we have traditionally as a rating agency, as AM Best, only focused on the insurance sectors and NOA. So we're global in terms of geography, but we're not global in terms of sectors. We only do insurer, reinsurance, and insurance captives, of course, or insurance captives. Now, for the first time, we're expanding a bit in these underwriting agencies, this type of company, what we call UA, because they also seems to be instrumental to how the capacity arises into the market. That's a real idea. And what do we do, however? We keep this kind of services separate from the rating service. So we provide what we call a performance assessment. I will not, this is not a sales presentation, I will not go into details on that, but let's say that unlike the typical rating service, which starts with the balance sheet, so the financial condition par excellence of the company, in this case, we start with other consideration, which is really the underwriting, not capacity in capital terms, but in terms of performance to interact with the market, etc. And we put the financial condition always in consideration, but only as a number 3 type of factor to look into that. If I wanted to leave you, I'm finishing. At this point, I would just say that it's possible to come up with outlooks. It's possible to come up with a forecast. It's possible to come up with all sort of prediction about what's going to happen tomorrow in the future. In reality, I think we should doubt even of those predictions. I think I had even a citation somewhere, which was the idea, I think it was taken from Descartes. The idea was, if you really want to become wise and examine truth, you should doubt everything at least once in your life. That's easy to say, not very, very much more difficult to do. But I think the concept is a little bit of that. So take full prediction with a pinch of salt. We want to be optimistic, otherwise we wouldn't be in business. But I suppose that the only lesson we can take from everything that's been going on over the last 5 years is that we need to be able to keep constantly rethinking the business we have. And with that, I will leave you for lunch. Thank you.